Welcome back to Smart Money on CNBC-TV18. We're talking about the big opportunity in the auto, transportation and logistics sector. Before the break, we were speaking to Harish Bihani of ICICI Pru about the big trends in the auto sector. And now let's talk about logistics, because a lot is being done by the government as well to push this sector. So tell us, what are the key trends here?
I think we'll have to kind of think about the big picture first over here in terms of what the government is trying to do. Government is trying to formalize our economy with the implementation of GST and all the other changes that the government have done over the past many years now. And in that context, government came up with this policies on Gati Shakti or the national logistic policy. Government is trying to do is to ensure that the efficiency of the entire system improves. And with that, the logistic companies or the logistic players or the overall logistic cost in our country at this point in time is in double digit as a percentage of GDP. This is leading to market share losses, especially global market share losses. So government is aiming that we should get this down to single digit, closer to developed countries over the next 5 to 10 years. If that happens, what happens is that we'll start gaining market share from global players. Our working capital level comes down. We become significantly efficient as a country, as some of the companies start gaining global market share. And this is the theme which is there. And in that context, as the overall country formalizes, the companies formalizes, there is a market share gain in terms of unorganized to organized. And that is another theme which is playing out in many sectors as we speak. It's already played out because of COVID. It's got even faster. And that is a theme which is going to play out significantly over the next couple of years.
So you want to compare the Indian markets with other developed markets. I'm just trying to understand what is the kind of potential that you see here in India versus other developed economies.
If you look at, say, the other developed economies, logistic play a fairly critical role, whether it's the port players, the rail network, the road network, etc. And these are in terms of the absolute sizes, these are far bigger in terms of the absolute size, right? And why does that happen? That happens because you look at these formal companies, some of these organized companies, they keep gaining market share from the unorganized players. So that is what has happened in developed markets, which is going to play out in the domestic market too over a period in time. Because the efficiency which a formal organized company will be able to get to over a period in time is going to be significant. So this is a trend which has played out in most developed markets. Big have become bigger in logistics space, and that is going to happen in India too.
So, there are a lot of players here, right? You spoke about delivery a while back. There's TCI Express, and several of them have been gaining quite a bit of market share as well.
Correct.
Tell us that, what are the top companies here that you would look at? I mean, these are, of course, not recommendations, but where do you see the shift from the unorganized to organized? Who do you think could be the big beneficiaries of this?
All across. You look at whether some of the largest port companies, think about what the size 5 years back versus today, and think about where some of those will be. Similarly, you look at some road logistic players, there was a lot of hurdles because unorganized used to be a significant part, and there used to be a lot of tax leakages in the system, which is getting plugged as we speak, and that is going to even get plugged over a period in time. So some larger companies will keep gaining share. Similarly, you have the rail operators. Again, there are credible companies in this particular space. So in each and every space, you have credible companies that have been gaining gradual market share, and this trend should likely continue. Again, as we spoke in terms of the auto plays, there are companies which are investing, whether it's in people, process, technology, etc. We have to identify those companies which are reinvesting what they are gaining at this point in time to ensure that they are on the right side of disruption. They will gain market share over the next 3, 5, 10 years to come.
Okay, so you have a fund, right? An NFO. There's the ICICI Pru Transportation and Logistics Fund. You spoke about what your entire investment rationale is, but tell us a little bit more about this fund. What are the kind of stocks? If I'm an investor in this fund, what are the kind of stocks I would get exposure to? You
will get exposure to the entire gamut of auto OEMs, the best in the class, with right model cycle, right market share gain opportunity, right volume value growth opportunity. Value will come from premiumization, right? You will get opportunity in terms of margin expansion because commodity prices are coming off, and most of these OEMs have passed on all the cost hikes to the consumers. And this is going to be a gradual play. Similarly, you will get the best of the auto ancillary companies. These are great entrepreneurs who have reinvested money to ensure that they get those higher component value, as you spoke about in one of the examples. And again, in logistics, you will get the companies which are formal already, but these are organized companies which will keep gaining market share, and this is fairly big opportunity over the next 10 to 15 years.
Okay, but the problem with thematic funds is that, I mean, they of course are back in vogue now because the market is sort of picking up. But generally for a long-term investor, thematic funds tends to get a bit tricky because you don't know when that theme is going to its life cycle is going to play out. What would your argument be to that?
No, absolutely. So one has to think about the context of where we are in the business cycle, where we are in the growth cycle and the margin cycle. So when you think about these three characteristics, and then you think about the overall kind of changes that could happen, you would see that we are at closer to the bottom of the business cycle, the growth cycle and the margin cycle. So one should be worried when you are at the top of these particular cycles. We think that we are not there at this point in time. Or you would get worried if our country is not growing, the income levels are not growing, and there's a large section of the society that will continue to struggle beyond, say, the near term that we are already seeing at this point in time. But if you think that our country will get far more affluent and there will be a section which will continue to buy more discretionary goods, then this is a theme which should play out on average in the long term, right? So that is what our call is.
That's the rationale. Okay, well, Harish, it was a pleasure speaking with you. Thank you so much for joining us on Smart Money, and all the best for your fund. Okay, that's the big space that we're looking at, right? The transportation, the logistics theme, and what to expect over there. But time now for the financial tip of the week. This is our weekly column where we tell you how to be financially savvy. And today we're going to talk about 3 important details every public provident fund account holder should know. Now, on the taxation front, we know that if you are a PPF account holder, then there's the magic of exempt, exempt, exempt. However, since the last year, there is a new rule in effect. It's an unknown fact that there will now be a TDS payment on partial withdrawal in excess of 20 lakhs if the person has not filed the income tax returns in the last 3 years. So your tax is not completely exempt. If you don't file income tax in the last 3 years, then you would have to pay partial TDS on your PPF amount. So that's something that you need to keep on your radar. The second is on the maturity date of the PPF, the Public Provident Fund. We all know that the Public Provident Fund maturity date is 15 years. But here's a fact that not too many people know. The maturity date is not calculated from the date of opening the account. The 15 years is calculated from the end of the financial year in which the first deposit was made. And finally, a PPF account for minors. If you want to open a PPF account for minors, you can, but it can be opened by either parent. So one account per child. You cannot have 2 accounts on 2 different names, and grandparents cannot open a PPF account for a minor. So these are just some financial tips we thought we could share with you every week. Helps you to become financially savvy. Well, with that, it is a wrap on this edition of Smart Money. Thanks a lot for watching.